would like, if I may, to take you on a strange journey.
Hello, you magnificent rebels. Welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California and member of the National Association of Realtors. But please don't hold that against me. God, is it only Tuesday? I hope you're plowing through the week better. I hope your momentum is better than mine this week. We'll see. It could be a very good news day for my clients. Hopefully, escrow will close today. Even saying those words, I feel like I'm jinxing it. Interesting, weird stuff on this one. Kind of in line with the weird stuff we were kind of talking about yesterday and last week. So once it's all wrapped up, I'll give you the lowdown. Frankly, I'm not sure it gives you any new advice if you listen to the past shows and you took to heart the stuff I suggested you do. I think it all kind of just reinforces the same stuff I've already said. But we'll do a quick review because I think it's always good to get a little bit of a touchstone with reality on a lot of these things we talk about. And of course, that's kind of our thing, right? We always want to try to get as much real world perspective on these things as we possibly can. If you'd like to get in contact with me, the absolute best way to do that is going to be through the website at www.therebelbroker.com. You can select the Contact the Rebel Broker option in the menu and send along any ideas, suggestions, observations, or questions that you might have, and I will be oh so happy to respond. So feel free to head over there and take care of that. While you're there, why not head on over to the survey to help get this show going, get it off the ground, get it on a paying basis. Let's expand it. Let's take it to the next level. Let's crank it to 11. Best way you can help me do that is to head on over to the survey, click the big red button at the top of the page, take the survey to support the show is what I believe I named it. Answer, I think it's 5 to 7 questions, helps identify the demographics of the show, and therefore helps me. So appreciate the time that you will take to do that for me if you find time. A couple of interesting ones today. We've got one that I'm interested in just because it's one of those ones where if you actually think about it, it kind of makes you say, wonder why that's true. This one comes to us from CNBC. Headline, mortgage rates finally break higher, what you should watch. And of course, if you're someone who's been paying attention to this show, none of the things they're about to say are a huge surprise for you. The article starts off with mortgage rates took their biggest leap in 2 months on Friday, thanks to a sell-off in the U.S. bond market. And of course, when there's a sell-off in the bond market, that scares people. Mortgage rates loosely follow the yield on the 10-year Treasury. It was only an eighth of a percentage point move, but enough to send stocks of the nation's home builders, such as well as anything else that touches housing, tumbling. Does anyone find that odd? It was an eighth of a point. My first thought was, is everything really so delicate right now that an eighth of a point change? An eighth of a point change. 1/8. Cut a pizza into eight slices. That's a 1% change if you get rid of the whole pizza. You take one of those 8 pieces, right? I don't understand why that would cause such a big deal. But sure enough, that's what it did. It scared home builders, all kinds of different housing-related folks. The article goes on. The numbers on the tickers are dramatic, but the impact of higher mortgage rates on the nation's neighborhoods will take different forms. First and foremost, rising rates scare a whole host of housing players, buyers, sellers, builders, homeowners. The average contract interest rate on the popular 30-year fixed-rate mortgage is still historically very low, around 3.5%. The historical average for the rate is just more than 8%. it has been as high as 18%, still a move higher, is scary. And I find it, so here's what I find scary. I don't find the 1/8 of a point increase in lending at its current levels as a scary thing. What I find scary is the reaction of the market. that given, let's try to dissect this a little bit. The narrative we've been sold is that there's all this confidence, right? They try to quote confidence numbers from builders. They try to quote confidence numbers from buyers and sellers and how things are either good or getting better. They point to all these different things, whether it's lumber prices, which actually aren't going up, so that indicates lower demand for lumber, which means less construction, right? Or they'll spin that and say, well, it's natural because the building that is going on is multifamily construction, which uses less lumber. Okay. But my point is, there's all these other things that supposedly point to this healthiness, the unemployment numbers, healthiness, all these different things. Of course, on this show, we've tried to get beyond just the surface stuff that we're shared with, and we've discovered there's instability in all of the things that are being sold as big things to tell us that the market is really robust right now. And you know what? Given what I'm seeing as a reaction to a 1/8 of a point change in an interest rate, tells me we're probably right. Because if all of those other things were the influential touchstones that were being sold that they are, there's no way that an 8% change in the interest rates that still keeps these interest rates below 4% would scare all of these various players in real estate, in the real estate marketplace. Here's the vibe I get from this reaction. I don't see people with a lot of confidence here. And I'm talking about the players. I'm talking about the builders. I'm talking about all the various real estate-related companies that were negatively affected by this. What I see are folks that are looking for the smallest ripple and don't want to know how the ripple got started, aren't really interested in the source of the ripple, but are absolutely in a mode to jump at anything. Even something as what I believe to be as mild as a 1/8 of a point shift in interest rates. Now, if some people might argue, okay, well, it's an 1/8 of a point. Oh my gosh. That could be a big deal, right? Well, historically, no. When the market was a little bit more robust, when we first were coming out a couple of years ago, when things were really hot, and even then you could argue things weren't hot in a normal way, but they were hot. We had far bigger changes in interest rates than that. Remember, we had interest rates over 4% for quite a while during that big boost of selling activity and buying activity. Did not scare away buyers for a second. So why is that suddenly much more of a thing now? Well, because I think that all of these other elements that everyone points to as being so great aren't so great. And I think a lot of folks here get that they are on very rocky terrain, and it could be anything that sort of telegraphs the next big ugly thing. I know part of that is just sort of my gut feeling, so you have to decide how much faith you put in my gut. But I think I'm backing my gut up pretty well with some observations relating to other things that are going on in the marketplace. I just don't get how this particular change merits the response that it got unless these folks totally don't buy any of these other things that we're being told make the market more stable right now. So I think what this telegraphs to us is keep our eyes open, keep our eyes on this data and see where it takes us and see what kind of other dramatic responses we see to what would normally be relatively minor news. I don't recall seeing such a dramatic response in the stock market relating to fluctuations of this size as it relates to interest rates. So we'll have to see how it all goes. This article's semi-interesting. The sexy parts, I think I've really already shared. If you want to read it, though, I will, of course, have a link to it at the show notes for today's show. So head on over to www.therebelbroker.com. You can just click on the Read More link that's included on the front page where the show is, and then that'll take you to more details, including a link to this article, and also a link to where you can get a membership with Audible and support the show that way too. So feel free to take advantage of that. Now, the other thing on our to-do list for today's show is to take a look at the second quarter report for the top cities with the biggest rent hikes. Now, one reason why this is a sexy thing to know is because these are the top places potentially for single-family investors to move their gaze to. And of course, a lot of this is going to be taking a look at historical data as well. In addition to knowing that that rents are rising in these areas, it's also going to be important to know where we are in that increase phase. Has it just started, or is this something that's been going on for a while, and is there a strong possibility that we're already really at the top of the market in some of these? So for these that sound interesting to you, you're going to want to go to the extra trouble to find this out, get a little historical data, find out what the trend has been for a while, and get a feel for whether or not you're at the beginning, middle, or end, really, of a rally, because you don't want to jump in at the end of a rally. So just take that for what it's worth. Now, the source of this data is Rent Range. They're a provider of market data and analytics for the single-family rental industry. They ranked the top 25 U.S. metropolitan statistical areas by average rental rate increase for single-family homes between the second quarter of 2016 and the same quarter in 2015. So same periods of time, 1 year apart, exactly the way you want to be looking at these numbers in order to get an idea of what you can expect, taking out any particular seasonal things that might be involved. Rent Range uses data from approximately 250,000 single-family houses per month, and yields are derived from Rent Range's proprietary automated valuation model. So let's go ahead and run down the top 25 list as set by Rent Range. But before we do, we'll take a quick break, so don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We're about to jump down the top 25 list of cities with the biggest rent hikes right now. A great tool for you to potentially turn your gaze towards communities that you may not have thought about before, simply because they are seeing such robust growth in rent. In addition to that, this article also gives us the average gross yield for each one of these areas, and the higher number is better. So we'll go through, we'll share both of those numbers. I'm trying to see if there's any, there's interesting discrepancies between the two numbers, because remember, just because rents necessarily go up doesn't mirror the idea that you're going to make the most for your money in terms of what you've invested into the property to acquire it, right? It's always about the amount of money that you have dedicated to the property and then comparing that to the payoff, right? Because you're always, for me, it's the highest level of utility for your resources. And if I have $10 and I can make $5 a year off of it with it being used up in something, I want to know that. I want to know that I'm making $5 a year for that money I've put in, or if I'm making $5 a month, well, that's great, right? That's a great utility of my money, because by the time we get to the end of the year, that's $60. So that's good. That's in less than a year, I'm replacing my investment. In 2 months, I'm replacing my investment in terms of what it's paying me. So you're for me, it's all about that. If I could take that $10 and put it into the stock market and it made me $6 a month, well, that would be the smarter thing to do, right? And then, of course, it's all comfort levels at that point as well. Maybe you theoretically could make $6 a month on that money on the stock market based on what you've seen other people do, but maybe you don't have a comfort level there. Maybe you don't feel like you've got the skills some of these other guys that are getting those results to get those kinds of numbers. Maybe your comfort level is better in real estate. So that's something to take into consideration as well. Your comfort with being able to generate the level of return consistently that will make it a good investment for you. So always kind of keep those numbers in mind. So let's go ahead and start with number 25. Number 25 on the list is Montgomery, Alabama, with a 10.1% increase in rent from the second quarter of 2015 to the second quarter of 2016, with a 14.89% average gross yield. That's pretty darn good, and it is probably in the top 5 of this list. I'm seeing 1, 2, 3 others. So yeah, it's in the top 4. I'm seeing 3 others that are better, but that's pretty good in terms of just. So even though we're at number 25. I find that intriguing. You're still getting an increase in rent, but your yield is higher. Your gross yield is higher. Now, so keep that kind of stuff in mind. And this is the argument I was trying to make, well, I've tried to make over and over again, where it makes more sense for folks that own a $1 million property in Silicon Valley to sell that and buy it in one of these kinds of communities where you're making more per property. So just buy 4 or 5 of these less expensive properties that give you more yield per property, right? You're going to make more. And there's some good examples of that coming up. So we'll talk about that in a second as well. Number 24 on the list, Grand Rapids, Wyoming, Michigan, 10.3% increase from second quarter of 2015 to the second quarter of 2016, with an even better performing 15.62% average gross yield. And that's these worst 2 on the top 25 are giving great gross yields. Number 23 on the list, Bridgeport, Stamford, Norwalk, Connecticut, 10.6% increase in rent, with an 8.83% average gross yield. Now, another thing that I think is important when you look at these historical numbers, now, because the first thing I would jump to is being less guided by the change in rent and more guided by the gross yield. But I'm not just from an investment standpoint. You want to try and get all the different aspects, right? You want to find out the velocity of a number like this, and velocity simply means how fast is it changing? What's the rate of change? Now, granted, if you're looking from year to year, the higher the number here is, well, the greatest rate from that point to that point. But what you want to try to do is figure out what is that rate over a longer term. Are we seeing a history on this where the amount of growth we saw over the last year was actually a little bit lower than previous years, or was it about the same? Was it much faster? Was it much slower? So you want to, and these are ways that you can sort of define what direction things are going. Are things currently slowing down? Are they speeding up compared to past years or past quarters? However you want to crunch those numbers. So always make sure that you're getting as much context as you can. And that's basically just you looking at a number and then looking at the numbers next to it, going back to figure out what is the context, what's going on. And trying to get as much of an explanation as much as you can as to why it's moving the way it is, because understanding the why of it will also help inform you on how long you think it's sustainable. What is this something that's happening because there's diversification going on in the economy of this area, so more people are being drawn in? And are those industries that are moving in things that are likely to stay here for a long time? These are all questions that if you get them answered, or at least feel like you've got enough of a handle on them, it can really increase your comfort level with whether or not you think it makes sense to invest in these communities. Okay, next on our list, number 22, Santa Rosa, Petaluma, California, 10.7%. And the Santa Rosa, Petaluma area, definitely areas that would have benefited from that San Francisco mushroom we talked about in terms of communities that would see growth in purchases and rental rates and all these other types of things based on the fact that folks were just tired of paying the nut in San Francisco to buy an average property for $1.2 million. So as we said, 10.7% increase in rents from year to year between 2015 and 2016 with a 5.49 average gross yield. So that's the worst we've had so far, right? That's not very sexy. Next on the list, number 21, Salinas, California, 10.8% average change in rent, 5.45% average gross yield. And Salinas is one of those communities that I'd be a little bit more hesitant of. If there's another downturn, this is going to be one of the first communities that takes a huge, gigantic dump. Believe it or not, there are folks who commute from Salinas all the way up to the Silicon Valley area. Salinas is further south than me. It goes Morgan Hill, which is where I am, then a little town called San Martin, then Gilroy, then way down there is Salinas. So that's definitely a canary in the coal mine community, but I'll tell you, it's super affordable. So it's one of those areas where if you're looking for a very low barrier to entry, Salinas is a potential option for you. Absolutely a place you're going to want to get ground truth. It's one of those areas where you definitely need to be careful what part of town you're buying in, and you want to make sure that you're buying in the most stable and most desirable end of town, because if that market does start to take a turn, the areas that are less desirable are going to suffer first. Okay, number 20 on our list, Portland, Vancouver, Hillsboro, Oregon, Washington. And that's a gigantic area to average out for rents. It always annoys me when they do that. 11.2% increase year to year in terms of rents, 6.52% average gross yield. Number 19, and there's an awful lot of these. We're seeing Florida is fairly well represented, and Florida has been consistently on our list of go-to places for investments according to a lot of the different articles that we've covered over the last 6 months or so. Number 19, Palm Bay, Melbourne, Titusville, Florida. 11.3% increase in rents, 10.76% average gross yield. I think that's respectable. Frankly, anything above 10% turns my head. So I think that's stuff that makes it very, very interesting to consider. Number 18 on our list, Naples, Marco Island, Florida. 11.5% increase in rents, 8.07% average gross yield. Number 17, Shreveport, Bossier City. Bossier? I'm assuming there's a French thing going on there. We are talking about Louisiana after all. Shreveport, Bossier City, Louisiana. 11.5% increase in rents. 15.29 average gross yield. I like that. That is the highest number on our list in terms of gross yield. I know nothing about Louisiana. I know nothing about Shreveport or Bossier City. But those two numbers, that number alone, makes it interesting to me in terms of wanting to get a little bit more ground truth about what is going on there. Maybe if we've got time, maybe we can go back and check that town again, because I actually think that's the first time we've ever seen that group, that area, show up on one of these lists. So that'd be interesting to look at. Most of these other areas we've heard about. Salinas, I think, may also be a new one. Santa Rosa, Petaluma may be new, but I think a lot of these other ones have actually been on our list before. Let's see, or haven't been on our list, have been on our list before. Number 16 on our list is San Jose, Sunnyvale, Santa Clara, California, an area I am ridiculously familiar with. 11.5% change in rent year over year, with no surprise here, the lowest average gross yield on our list, 4.39%. So if you're using that number to kind of calculate the utility of your investment, that's your worst option on this list. Number 15, Little Rock, North Little Rock, Conway, Arkansas, 11.6% increase in rental rates with an 11.7% average gross yield. Number 14, San Francisco, Oakland, Fremont, California, 12% increase in rents with a 5.35% average gross yield, which is the second worst on our list. So remember, the cities that you probably have heard about most in the news, the ones that get talked about as the hottest real estate markets, the ones that are just the rock stars, have the lowest average gross yield. They're getting good rents. They're getting in the top 25 in terms of increases in rents. But even with these increases in rents, their average gross yield is dragging. Number 13, Atlanta, Sandy Springs, Marietta, Georgia. Now, I know Atlanta was on a couple of lists we've looked at over the last couple of months. 12.3% change in rent from the second quarter of last year. 11.77% average gross yield. So another sexy over 10% number. Number 12, Pittsburgh, Pennsylvania, with 12.6% increase in rent year over year and 15.14% average gross yield. So again, a very sexy number. Nashville, Davidson, Murfreesboro, Franklin, Tennessee, 13% change in rent from the second quarter of 2015 to the second quarter of 2016 with a 9.85% average gross yield. We talked about Nashville on several shows, so not quite 10%, but maybe close enough to make it worth looking at, considering it's been mentioned for other reasons in other reports relating to what makes a good investment area. Number 10 on our list, Santa Barbara, Santa Maria, Goleta, another area in ancient history I'm familiar with. I have family down there, and I used to spend a lot of time down there visiting, but I think that it's been decades. So anyway, 13.1% change in rent, 5.57% average gross yield. So again, kind of a low gross yield there. Number 9, Charleston, North Charleston, South Carolina, 13.7% increase in rent, 9.77 average gross yield. Number 8, Huntsville, Alabama, 14.4% change in rent with an 11.45 average gross yield. That's a good number. I like that. I don't know about Huntsville, Alabama. Anybody know about Huntsville, Alabama? I don't think I've ever done any research ever on Huntsville, Alabama. Syracuse, New York comes in at number 7, 14.8% change in rent with a 15.14 average gross yield. If I am not mistaken, Syracuse has also popped up on a couple of other lists relating to kind of shiny little points of light out there in the you should invest here pantheon of stories we've talked about. Number 6, Knoxville, Tennessee, 14.9% increase in rent from second quarter to second quarter. And we see average gross yield in that city of 10.56%. Boy, I tell you, Tennessee seems to be producing a target-rich environment in terms of different communities. Knoxville is another one I know nothing about, but we've already talked about Memphis, Tennessee. We've talked about Chattanooga, Tennessee. Now we've got Knoxville, Tennessee. I think Knoxville may have been mentioned in one other, but it's actually been the big brothers in Memphis and other communities that have been getting more love than Knoxville. But those numbers are good. When you're seeing that level of increase, it's coming in at number 6 in terms of increase in rent, and it's got a good gross yield. Number 5, Port St. Lucie, Florida, 15.2% increase in rent from the second quarter of 2015 to 2016 with a 10.28 average gross yield. Number 4, Deltona, Daytona Beach, Ormond Beach, Florida, 15.7% change in rent, 10.2% average gross yield. So again, super sexy numbers. Number 3, Seattle, Tacoma, Bellevue, Washington, 16.6% increase in rent, 6.17% gross yield. Number 2, New Orleans, Metairie, Kenner, Louisiana, 20.6% increase in rent from 2015 to 2016 with an 11.78 average gross yield. Again, over 10. I like over 10. That's kind of my number. Number 1 on our list comes in at 26.1% increase in rent from year to year. Man, would I love to see the historical chart on that. What's been the average change of rent quarter to quarter over the last, say, 5 to 7 years. Cape Coral, Fort Myers, Florida. Fort Myers, I know, has been specifically mentioned in some other reports that we've done on good places to invest. They also have a 9.14 gross yield. Now, if we want to go with just the top handful and call out the ones with the best average gross yield and also the ones that are kind of occupying top spaces here, you got to go with Syracuse, New York, Knoxville, Tennessee, Port St. Lucie, Florida, Deltona, Daytona Beach, Ormond Beach, and New Orleans, Metairie, and Kenner, Louisiana. Those are clearly the standouts. Louisiana is the representatives for Louisiana all seem to be giving really good gross yields. Shreveport, Bossier City was also in that mix, which was the only other city in Louisiana. So good numbers. If you are someone has an interest in any of these areas, you'll like the way it sounds, let these numbers be a starting point for you. Jump in there, take a look, get a little historical data. And remember, there's tons of stuff you can do online. You never even have to break a sweat, buy a plane ticket, put a gallon of gas in the car. Never got to do any of that stuff. You can get an awful lot accomplished just by jumping online. Go on to Realtor.com, go to Redfin, wherever you like. Do Google searches on real estate market information for these various cities and see what you can see. You're going to find a wealth of information out there that it can at least give you that first blush of insights into what's going on in those communities to see if it makes sense for you. And you can check everything from crime statistics to census data to hiring boards. How many jobs are there and what kinds of jobs are being posted on the various employment sites for these areas. These are all things that are going to give you a little bit of insight into what's going on in those places and hopefully help to form a picture for you so that you can make that decision on whether or not it's worth your time to head out there and start taking a look at things in person. All right, folks. Of course, I am forever in your debt for taking your valuable time and spending it listening to this show. Thanks for listening. I'll talk to y'all next time.